Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for the week ending Friday, January 21st, 2022. This will be just a brief wrap up. We won't go into detail. Yesterday, did the in-depth video reiterating some of the longer term price targets, and what I wanted to say is everything that I've seen since then and really over the last few weeks continues to increase the odds that we're going to get there. In other words, I wanted to just start out here on this 120-minute chart of NQ. I got that out to you guys before the close today, to subscribers the right side of the chart, that is. And that is my if the dam breaks and things get ugly target. That's what I called it back here. Remember, we've been short. We had several short entries. First one was this trend line break there. Then you had the nice bearish rising wedge up here with the second short entry right there on the wedge break. And since then, it set up several other objective shorting ups. So we had, I'm sorry, 1, 2, 3, 4, every back test to this level here, 16, about 16,445, including the pop that we had because that occurred over the holidays. As I said, that's more than common to see on the very low volume trading week around Christmas, to see a little whipsaw like that. So we kept on our shorts, waited for another sell signal to come on the break of this uptrend line right here, that steep uptrend line, and that was another objective. So we're average cost on most of those entries up there is right around that 16,445, and that gives us today about a 12% profit so far. And it's again, back then it was, we were targeting, I had some shallower targets, and this is really where the dam started to break, because I talked about this whole thing here. I know I'm drawing so many lines now, making your head spin. This whole thing here, as well as S&P 500, was the post breakout. There was your all-time high right there at the time in the Nasdaq 100. There was our breakout. We back tested a few times, and once we failed it, we clearly failed it. Now that has increased, in my opinion, significantly opened the door for a lot more downside. So I'm going to speak mainly to the near term, but I just wanted to reiterate, I believe regardless of what happens next week in the coming days, we're going to continue most likely to go down. There's still some long-term trend indicators that need to be taken out, some key support levels. I'll talk a little bit about some of those today, but again, we're only going to stick on the shorter term charts. So, as I said before the close today, we still, by the skin of our teeth, or by the skin of its teeth, the NASDAQ 100 NQ, we're looking at the 120-minute chart, 6 months of price action, 2-hour candles on the NQs. Still, by the skin of its teeth, has that positive divergence that it's had since yesterday, really. So we had that extra, little wedge breakout. Remember the false breakout I pointed out yesterday on the 60-minute charts right there. You had that nice, clean, bullish falling wedge. You had the breakout. Unexpected to break out, and it did, but then they sold right into it. And then there was that flag today. So this is what I want to talk about. So I'm going to jump back to that 2-hour candle chart. So this morning I pointed out the bear flag continuation patterns that's right here. You can see it well on NQ and ES. So you had a flagpole, which is that impulsive drop down to that area of consolidation, and then the impulsive breakdown today. Now that flag's going to measure down. It's going to be the distance of the flagpole, or that impulsive leg down leading up to the flag, and then you add that on. So if that plays out, then that's going to take us down next week. But on the flip side, as I mentioned, we also hit that target, a price target. Usually you're going to get a reaction off there on the initial tag of a target. It's Friday. You have 2 extra days of overnight risk, and you have the Fed on deck next week. They're going to meet on Monday or Tuesday and Wednesday. The announcement will come at 2 p.m. Eastern time, as it always does after the meeting. And I believe I might have misspoke earlier today, and I mentioned that they had priced in a 1/4 point rate hike for this meeting. I meant to say it's in the March meeting is when the expectation for the markets is. We're going to hear Powell talk, and that's going to certainly lead to some knee-jerk reactions in the market. So all I can tell you is expect some volatility on Wednesday after, from 2 o'clock on. But normally the markets will go into a holding pattern the closer you get to that announcement day. So we may see, markets are probably going to gap up or down on Monday, and that's what I told you today. So I lightened up. I think it makes sense to lighten up on your positions, whether you're bull, long, buying the support, or you're bearish and short. We did get more of my, pretty much my all-in moment the other day when we took out those, clearly took out the levels on the SPY and NQ. So, it's been and again, I always say this, not all your entire portfolio, but, full short position up until today. I think, again, it makes sense to just lighten up. Because anything can happen over the weekend, and we did hit some key support levels, so we're going to talk about those there. So that's NQ, the Nasdaq 100 futures. This is ES. This is the 6-month chart, and you can see there's really not a lot of support there, but we do have the S&P 500 at around the 200-day moving average. You won't see it on here on the futures. It's a 120-minute chart, but I'm going to drop down to the hourly chart. And again, highlight those bear flag patterns that I pointed out earlier today. And the fact, let's move these in here. There's little divergence right there. Still have the RSI divergence, a little bit of divergence on the PPO. So just to kind of show you, that's the impulsive move down. There's your flagpole. There's the impulsive breakout of the flag. And again, the flag would project lower. So you can call it saved by the bell if you want, because we're sliding into the close today. But now let's look at the charts of the indexes. And this is QQQ. QQQ is sliced through the 200-day. Had a little reaction on it a couple days ago, but sliced right through it. Here, you turn off all the lines. You can see that. These are the 200-day simple moving average in blue and the exponential in red. They both come in together. And so, again, we had about a day's worth of consolidation, a little bounce when we first hit it. Move down. It's not unusual to see it one of the two indexes slice below. That's why there's a lot of indexes out there, but the ones I focus on are the S&P 500 and Nasdaq 100. I've also been doing a lot of analysis on the small caps. There's an instance where we overshot it by quite a bit on QQQ. I think you can make it out in the video. Sometimes I forget. People watch these things on phones and tablets and stuff, but there was a slice through and then a recovery. So usually when you've gotten quite a bit away from it, it is pretty unusual to just take it out and keep going without at least a reaction. Even when COVID hit, or this was the fourth quarter drop in 2018, I'm sorry. But you hit it, you bounced, and you traded around it, then you got under it and its resistance. So again, it is possible, and I've warned of this lately. I've warned of the potential, like I've given you the what I call my crash warnings, using the analogy to tornado and hurricane, a warning versus a watch. A watch as conditions, there's some conditions out there that could lead to a big drop in the market, where a warning is a likely, the chances are much more likely for an imminent hurricane or tornado. And I gave the analogy of where I lived the other day with the hurricane watches, or I'm sorry, tornado watch. Warning, that is, warning here in Florida, and of course it ripped, within blocks of my house, F2. Anyway, there's the drop in QQQ. However, remember, QQQ is, so far, tech has been leading this thing down so far. A lot of other sectors are starting to catch up, but there's the S&P 500. So this is a takeaway. Same, really, where I picked it up this morning. We're right at. We closed parked right on, a hair below the 200-day simple moving average. Again, that's the red line. The 200, the blue is the exponent. I'm sorry, the blue is the simple. The red is the exponential. And of course, I like to watch them both, because some traders use one, some use the other, and at times, the indexes will hit one or the other and bounce. So that's it. I've covered this in detail. I'm not going to go over too much now. The last time we took out the 200s, we're back in when COVID hit. We broke them, but of course, we overshot and we back tested. So if you missed the initial breakdown or you weren't short here, we had shorts on the site there. You had a chance to get in on the back test, and we even gamed that bounce based on the charts as well, the intraday charts. We covered our shorts right about there, wrote it up for that 10% or so bounce, got short again, and then covered right before the lows and went long right there. Put on official trades as a long. But that's it. It's just done a great job of defining, acting as support these 200 days during an uptrend, and support once broken becomes resistance. So that's it. And this is the first time all the way since back here, since right after the COVID lows. Once we recovered, we back tested those 200s from above. But again, you go back in time. And so that's it. So this is kind of reiterating what I said this morning in the video. It increases the odds, the fact that we hit this 200, and you have the Fed on deck on Wednesday. So we could, gap down in the morning, certainly, and overshoot it. if anything else happens, and it's possible, because guys, I keep again though can't underimpress the importance of all the red flags I pointed out, and the reason I put that, I've been talking about that, uh, tornado or crash warning on the market that I've given based on deteriorating fundamentals, deteriorating market internals as well. More so, the market internals, excessive bullishness, technicals, everything that I've been talking about for the last couple of months here, they're all playing out now, and what that would lead to, and is leading to, and could lead to more, is a crowded rush for the exits. Otherwise, this just maybe another pullback. Look, right now, like I said, this drop is about, it's in the S&P, it's not as bad as the Nasdaq. It's only about a 10% drop, and that's run of the mill in a bull trend. You get these 10% pullbacks and you buy the 200. And again, I'd be surprised if they don't step in, but not shocked, but surprised. So that's why I think it makes sense to just lighten up. We weren't short the SPY. I told you I was clear on my preference short the small caps and the Nasdaq 100. So we're up a good 12% or so on those. And yeah, by lightening up, and or hedging up. I gave you the Netflix trade idea today. We can pick things up next week and then get back into those positions. The ideal scenario is going to be to get a bounce. And again, I don't think it's going to go very far because I think the market will go into a holding period. If it's anything else, nothing would surprise me at this point because I've seen waterfall type sell-offs before, and these are the market conditions. Like I said, all the conditions are ripe for just a meltdown type thing. But let's see. We could always jump back in later. Maybe you miss out on a few percentage points on the way down, but it's a lot better than waking up on Monday to a 3% gap up or successful recovery of the 200. So as I talked about earlier, about potential bounce targets. At this point in time, really, the market has no business being back above these recent trading ranges right there. You have on both QQQ and SPY. There was the breakout above all-time highs. We backtested a couple times, and then gave it up. So that would be a potential bounce target. Well, that would take us all the way. It'd be about a 7+ % bounce in QQQ if you got it. SPY, there's the range. Let me put up my box. There's the box I have right here. And we're below that box, so I'll do it this way. Show you that there's the previous high right there. So there's our post breakout trading range, and there's the failure. That makes that a failed breakout, false breakout, aka bull trap, meaning all these longs that jumped in, bought the breakout to new highs, now realize the breakout failed, so their stops are getting hit. Shorts are like sharks; they smell blood in the water. They're piling in, but and then again, based on what's happening, we could go down. I'm here to just tell you that my comfort level says, hey, I got some nice profits over the last few weeks. Take some profits and then pick it up next week and see where we go. But there's those 200 days, and like I said, divergences hanging in there by the skin of their teeth, but they're still there. And again, I don't think they're not the type. In the past, those 60-minute divergences have been the catalyst for the move up to new highs. At most, we're talking just a retracement now. And again, the door has been open for my longer term targets, which I've covered, including in yesterday's update. And here's the small caps. I mean, there's that, what I call just a beautiful range, so well defined. And as I've been talking about for so many months, if not, well, I've been talking about for many months, but the range itself goes for over a year. We entered that back in the beginning of last January, and I, use the analogy, it's like energy building up like in a coiled spring. You had that one failed breakout, that was your cue right there, and we tried to break above the range. Again, everyone sees what they want to see. Bulls saw breakout to new all-time highs, bought the breakout, and those that read the chart said, hey, breakout with negative divergence and overbought conditions has a much higher rate of failing, and it failed. And when it failed, as we usually do, we go back to the bottom of the range. They bought the bottom of the range a few times, and finally we broke to the downside. So hey, maybe this proves to be a breakout to the down, another whipsaw. And that's the thing about trading is we've got it now. We're so profitable in these trades. You can set a stop if they happen to recover that. There's no reason to ride it up that far. As I gave you, I think some levels yesterday about that 215. I think would be the maximum if they kick it back at this point in time. Really don't think it's going to even go that far because again, this is what I've been waiting to see. This is an impulsive drop. The breakdown, it doesn't let the wannabe shorts in. That the lows that I'll wait and see. All of a sudden we're down so far, so they're waiting for the kickback. On the flip side, the longs that get trapped refuse to sell when you're down 2%, and then the next day you're down 2 or 3, and I've made it clear, my target's still 170. I'm not even giving you intermediate targets. Doesn't mean we're going to go straight there. We could kick back, but I think the odds, I can tell you, the odds have gone up substantially since the breakdown. I gave you that target before we even broke down from the range, and now with these nothing but red sticks, impulsive selling, on a scale 1 to 10, that's a 10 for what you want to see for a breakdown. It does not guarantee it won't pan out. And look, by the skin of its teeth, well, actually, the divergence is almost taken out. If I look at that line, we'll just say it's, again, by the skin of its teeth. So there is a potential divergent low, and just like this divergent high, checked it, that could happen. But here's the thing. You're not going to ride it up there. You're going to, if something turns around and the technicals change, and I'll be quick to give you updates, the maximum I think you'd allow a IWM short to get out of, to get back profits would be 214.89. And if you shorted up here, in the midpoint, there was resistance there. We're below all the moving averages, the 50, the 200s, everything else. You have that bearish death cross almost about to happen here, and I'm talking about the 50-day exponential moving average, which is right here in yellow, about to cross below the 200, and if so, that'll just be another check mark. So that's it. Let's just leave it here. Again, I'm speaking to near term, what may happen next week. Anything is possible. When the dam finally breaks, sometimes you can get that waterfall type selling, and there's nothing wrong at all with remaining short. I just, I've been aggressively short, especially since we had the last all-in sell signals recently. But I'm going to sleep better this weekend, lightening up that short exposure, and I'll pick it up. If I see something that makes me want to jump back in and go to full-on, aggressive short positioning before Powell, and the Fed, before the FOMC announcement on Wednesday afternoon, then I'll do so. Otherwise, I'll probably wait because, again, you're going to hit some key support levels. If they step in and defend the 200-day on the S&P, let me get out there, you probably trade around it for a few days, and then boom, 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 continue on after a little bounce. And same story with the potential bounce targets. You got that key. I gave it in yellow. That was our all-in moment, really, when 450 finally gave way. That was the big level breakdown of that recent range, and so support once broken becomes resistance, so there's a potential bounce target for you if we do get it. If we don't, just sit tight. That'd be about 3%, by the way. And if not, just sit tight and hold out for those additional targets. All right, let's wrap it up here. And again, I'll do updates, pick it up Monday or even Sunday evening. If there's anything big in the futures, I'll get I'll get something out to subscribers on the right side of the chart. And otherwise, we'll pick it up on Monday. Have a great weekend, guys. This has been Randy Finney with Right Side of the Chart.